The global crypto tax crackdown will see tax authorities around the world automatically exchanging data about crypto investors from 2027. In this video, I'll talk about what's happening on a global level with regards to the taxation of crypto, what that means for you as a crypto investor, and what you can do about it and how you should proceed. Let's start off with what's happening on a global level. In November 2023, the UK agreed a joint statement with 48 countries to combat criminals who use crypto assets to evade and avoid tax. The countries who have signed up include the UK, the US, Switzerland, Italy, France, and loads of others. This standard is known as the Crypto Asset Reporting Framework, and it's the OECD's latest tax transparency framework. According to Taxation Magazine, the framework is intended to help combat money laundering and terrorist financing through crypto. Now, you might say that you're not investing in crypto for any criminal activities, but this framework will impact every investor who holds crypto for two main reasons. First of all, HMRC will have much more information than they currently do on people who buy and sell crypto. Directly from HMRC's news story, they say crypto platforms will need to start sharing taxpayer information with tax authorities, which currently they do not do, ensuring these authorities can exchange information to enforce tax compliance. So the language HMRC are using is telling us that they are going to have more powers over crypto exchanges and that they will receive much more information than they currently do. And so in that way, crypto anonymity will come to an end. And that means that if you make a big gain, HMRC are going to know about it. Secondly, the CARF is intended to build on the Common Reporting Standard, or the CRS, which was introduced in 2014. The CRS is the global standard for the automatic exchange of information where people hold a bank account in more than one jurisdiction. It means that, for example, if you were resident in the UK and you held a bank account in, say, Portugal, the Portuguese bank would share your details with the Portuguese tax authority, and then the Portuguese tax authority would share your details with HMRC, and the CARF will work in a very similar way. The CRS was hugely successful in combating offshore tax evasion, and there are hopes that the CARF will be similar. In fact, the European Commission have estimated that between 1 billion and 2.4 billion euros will be recovered annually. Now, it's important to say that HMRC can already request taxpayer information from exchanges, and in fact, Coinly have agreed to share information where an investor makes a gain of more than £5,000. But the CARF will mean that it's much easier for HMRC to obtain information about investors regardless of the gain that they've made on both a national and international basis. And there will be more of a requirement for exchanges to provide that information to HMRC. So how will it work? Well, the local tax authority will collect data from the crypto intermediary or exchange in their country about a customer, their aggregate investments, and the crypto transactions that they've made. They will then share that information with national tax administrations so that each tax authority will hold data for the residents of that country that hold crypto investments. Now, people aren't going to like this, and I know that because on my previous video on crypto, there were lots of comments around the fact that people didn't think that they should have to pay tax on crypto. Also saying that you pay tax on the money that you invest in crypto in the first place, so why should you be taxed when you cash out your crypto? And then some people saying that the whole point of investing in crypto is so that you have anonymity. But this is part of the problem, the fact that some people use crypto to participate in criminal activities and to buy illicit goods. So we have to have the expectation that governments want to know who is trading crypto, and of course, a byproduct of that is that they get to collect tax on crypto gains and income. In fact, HMRC will be hoping to recover millions of pounds annually on underreported crypto gains. Now let's talk about what HMRC will do once they have the data. HMRC will compare the data that they have from the exchange against what you put on your tax return, and they will look to see if there are any discrepancies. There are two things that they can do. First of all, they can issue a nudge letter, which is not a statutory inquiry, but it is a letter that you should respond to. And it will give you the chance to disclose any income or gains that you've made but haven't disclosed to HMRC for previous periods. And then secondly, HMRC may open a detailed inquiry if they think that you have underreported and not paid the correct amount of income tax or capital gains tax. It's important to say that you might not see anything straight away. HMRC can look back up to 4 years if they think that you've made an innocent mistake, or they can look back up to 20 years if they think that you've deliberately evaded tax. So you may not receive a letter straight away, but you may get one in a couple of years. And ultimately, not paying the tax will leave you in a worse position than if you had just paid the tax in the first place. But there are a couple of things that you can consider if you do want to minimize your crypto tax bill, which I'll talk about next. The easiest thing you can do is to make the most of every exemption that's available in the country that you live in. So in the UK, everybody is entitled to a £3,000 capital gains tax annual exemption, which means that if you made a gain of £3,000, you wouldn't have to pay any tax on it. You can also gift your crypto tax-free to your spouse, and then they could dispose of the crypto, make a gain of £3,000, and they wouldn't pay tax either, as long as they hadn't already used their exemption. So you could dispose of crypto, make a gain of £6,000 in a tax year and potentially not pay any tax on that. And then there are some more extreme things that you can do. So some people will tell you that you could move to a pro-crypto country that doesn't charge tax on crypto gains. And there are places that haven't signed up to the CARF, places like Bermuda, Dubai, and Monaco. But of course, you would need to weigh that up with the rest of your life and decide whether the tax on your crypto gains is worth a big move. And don't forget that often tax havens are expensive places to live, and there's no guarantee that they won't introduce a crypto tax later down the line. If you expect to make gains in crypto, or if you have already made gains and you haven't reported them to your local tax authority, then you may need specialist tax advice. This video is not intended to be a substitute for that tax advice. It's an education video explaining what's happening on a global level with regards to the taxation of crypto. Please like this video if you learned anything, subscribe to the channel if you haven't already, and I will see you next week.